how you can generate a realistic income of $3,000 per month, potentially even more, up until $10,000 a month, completely without selling your Bitcoin, by arbitraging all the Bitcoin financial engineering that you can do on an individual basis. We always talk about what strategy is doing, what financial engineering they are doing, but you can do a lot on an individual basis to build out your personal strategic Bitcoin reserve. Enjoy. You made something special. I think you connected all of them in one thing together. So I want to talk about income strategies. I want to talk about borrowing against the Bitcoin strategies. I want to talk about retirement strategies, and all of it in one place. But before we start, how do you look at that space? Income, retirement, Bitcoin, and all the tools that we gained basically in the last 12 months, not even.
Yeah, so at Salt Lending, I oversee our private client services program, and I work with a lot of high net worth individuals who are looking for ways to put their Bitcoin to use in retirement. And so a lot of the questions that I get and a lot of the time that I spend is with people who are, either approaching retirement or in retirement and looking to put their Bitcoin to work, but they still don't want to sell it, right? The they've accumulated Bitcoin over a period of years, and they understand its properties long term as a store of value, perhaps even one day as a more popular medium of exchange. And so they're looking at different ways they can put it to work, whether it's taking out a loan or whether it's putting it into a trust and taking out a loan and having their beneficiaries established in more of like a buy, borrow, die type of structure. And in the last few months, just as Stretch and Seyr, the preferred equities from Strategy and Strive, have become much more, popular across the space, both across TradFi, Bitcoin, and just there's a lot more conversations going on there. A lot of folks have come and said, well, how could we, is there something that we could do with you guys? We like your tools, we like your story, we like the way that the loans and everything work. How are you guys supporting individuals when it comes to Stretch and Seyr? And that's where things get really, really interesting because of the way you can set up the financing structure of loans now, the different custody options, the different downside protection options to ultimately remove some of those traditional risks that come along with loans, and then be able to take those proceeds and point them to something like a preferred equity like Stretch or Seyr, right, to basically generate that income that they're looking for in retirement. Or in some cases, different businesses, a Bitcoin treasury company might want to generate income in the same way. So it's definitely evolved and rapidly over the past 6 months or so as Stretch and Seyr have become a lot more popular.
Yeah, and there's a lot of really interesting strategies that now come from strategies product, Stretch and Seyr from Strive. And I just had, I think 2 episodes ago, Matt Colon from Strive. Really fascinating talk. I got off the phone with him, and I was like, oh shit, I have to buy some Strive. And literally on that day, I bought some stocks of his, just as a full exposure, full transparency for the viewers. Also, I think most people already know that I own some strategy shares also. But this is really interesting because now you can have arbitrage. You can use the borrowing against the Bitcoin strategies. You can use the arbitrage of maybe you get a loan for 5, 6, 7, 8%, and you can get an income from Stretch for like 11%. Let's see if it stays at 11.5 or it goes lower or higher. Maybe there is Strive that even has like the 13%. How do you look at those arbitrages and those possibilities that are now there?
Yeah, I think that's what's become interesting, right? As rates come down in the Bitcoin backed lending space and you compare that to the yields of these preferred equities, right? Looking at SEDA as the example at 13%, if you can take out a loan for, even 10%, right? You're still capturing a positive net carry of 3% right there. And I think the part that a lot of people don't think about is you're still allocated to your Bitcoin, right? So you're not only capturing a positive net carry of 3%, meaning you're earning more than you're paying, but you're also still allocated to your Bitcoin, which if you think that's going to do 25, 30% CAGR over the next decade, well then yeah, you're essentially offsetting all of your cost to take out that loan while even earning a small positive carry because of the difference in the interest expense and the yield. Um, Sam Callahan at Orange BTC, he did an interview at the Bitcoin conference talking about that exact concept, where Orange BTC, raises money, purchases Bitcoin, and then they borrow against some of that Bitcoin to buy. I think they're buying Stretch to capture that positive net carry. So you're even seeing some of the treasury companies and some of these strategies enter the business world as well.
How do you actually look at? I mean, maybe let's get into that later on because I'm curious how you think about Strife and Strife and Stretch, no, Seyr and Stretch as two different tools. But let's open the calculator because you brought that here, and just as a small disclaimer before, it's not live yet when this will be posted, but it will become most likely in a similar fashion live in some weeks or months. But we'll already show it to people. So that's a thing that you're currently working on, right?
That is correct.
And so now what you have done here is basically connect borrowing against the Bitcoin with strategy and Strifer's product SDSC and Seyr.
That's correct. Yeah, so we've basically taken a traditional one of our traditional Bitcoin backed loan products at 50% LTV, right? And so we've included the cost for that. The interest expense is 10.95%. So that's the math that's working under the hood here. I think the other thing that's important about this particular model is that this is with one of our newer products that carries no downside protection. So I think historically, people have looked at Bitcoin backed lending as perhaps carrying risk because, well, if I get forced liquidated, then I lose my Bitcoin and that's not good. Well, okay, well, what if we could eliminate that risk entirely? And that's what we've done here. So now the conversation can focus more on the math of, okay, well, what size loan are you looking for? And which of the preferred equity products do you like most? And what do you think the Bitcoin compound annual growth rate is going to be for the next, 1 to 5 years? Because by just plugging in those values and making those selections here in this model, you can actually see what the math looks like, when it comes to the loan and the cost for the loan against the dividends that you'd be earning from the preferred equity that you would purchase with the proceeds from that loan.
And so there's a loan amount of, okay, let's say the million, that's just the default values that were already in there.
Yep.
Bitcoin CAGR, that's a fun one because 30% I think is roughly realistic. There are people that say that's too bearish. There are people that say that's too bullish, but I think 30% is a kind of interesting middle period. I 5 years I think is always short term, but we can even go to 10 years. But yeah, let's keep it at 5 years. And what do we see here now? What is that?
Yeah, so what you're seeing here is you have two different options for looking at the math. And one is if you do capitalized interest versus interest only. So if you do interest only, what'll end up happening is now you're cutting into your dividends because you're making monthly interest payments, right? So if you're looking at this loan that comes with no downside risks, no margin calls, no forced liquidations, yeah, the price is a little bit higher, right? That's why it's 10.95%. And if you're paying 10.95% but only earning 13% from the preferred equity, well, then you can see right there your net monthly cash is only $458 because of your monthly debt service. Okay, but now go ahead and select capitalized interest. And now you can see your monthly debt service went to zero because you no longer have a monthly payment. You've actually capitalized the annual cost of the loan into the loan principal itself. And so as a result of that, you're going to have to post a little bit more Bitcoin because your loan principal went up by the total interest amount due. And at 50% LTV, you're going to have to cover that with more collateral. Other lenders do it similarly, right? Where they might have a deferred interest or a balloon payment due at the end of the loan. They all function in a similar way because they're all looking to achieve the same value, the same benefit for the borrower, which is no monthly payments. So now all of a sudden you've got a loan, right, that again has no downside protection, no margin calls, no forced liquidation events. And you're going to take the proceeds of that loan, that $1 million, and you're going to plug that into Seyr. And now you're going to collect $9,583 per month, right? And now because you have no monthly payment on the loan, well, now you've got over $9,500 to use as income. And that's why these strategies are becoming so popular within retirement, is because, well, how do I get income on my Bitcoin? I don't want to sell my Bitcoin, right? And if I just take out a loan and use that cash, well, okay, I could do that as well. But then you're justifying, Bitcoin's 30% CAGR with the interest of 10.95%. Whereas this strategy, right, takes it one step further. And now you're not only offsetting the interest entirely with the dividend on the preferred equity, but you're actually even earning a small positive net carry because of the 13% APY versus the 10.95% interest rate.
What I didn't fully get what the difference between interest only and capitalist interest is. That the capitalist interest with buying, for example, stretch, and interest only without buying stretch?
No. So on an interest only loan, you are going to make monthly payments for just the amount of interest that you owe on the loan, right? So if you have cash coming out of your pocket every month for interest, well, then that's going to cut into your ability to live on that dividend, right? So you can see there your monthly debt service when you have interest only selected is $9,125. And your dividend is, I don't know, whatever that is, 95 or 95, 83 or whatever it is. I can't fully see that.
Yeah, it's
So
95.83.
yeah, so your net monthly cash in hand after money out and money in is $458. Now, the difference in this scenario is look how much initial Bitcoin collateral you had to post. It was just under 26 Bitcoin, right? Okay, so now let's look at the trade-off. Go to capitalized interest. Okay, see now your initial collateral in Bitcoin went up ever so slightly because you're actually financing a larger loan now. And what that means is you are going to include the interest in with the loan principal, right? So now you're borrowing the cash that you're going to get, the $1 million, and you're essentially borrowing the interest that's going to be baked into the loan for that 12-month term. That's why your initial Bitcoin collateral value went up. And what this does, right, is it removes the monthly debt service that you owe and frees up the ability to receive the dividend fully realized so that you can spend that money. So
Also, what you're basically doing is you calculate advanced what would the interest be that I have to pay,
exactly.
and
And
then you put the remaining thing fully in stretch.
that's correct. Yeah, and the benefit here too is, let's say that Bitcoin went on a tear and tripled in the first 6 months of your loan, and let's say you wanted to pay off the loan. Well, you could do that, and with this structure, you'd get a credit for the unused interest monies that were financed into the loan itself. Or if you wanted to refinance the loan, the unused interest monies would essentially be credited to your new loan. So this is the way we do it, and this has just been through popular demand with borrowers, right? Because it offers the convenience and it allows them to borrow the interest using the future appreciation of the Bitcoin. So even though you're paying 10.95% interest in this particular scenario, you are a borrower who thinks that Bitcoin's going to appreciate at 30% every single year. So it's an easy way of, accounting for the interest monies owed without having to make monthly interest payments.
And what is now the net position and hodl kager? So what I understand from just seeing this here is that's your Bitcoin position, and you lost a little bit from like if you just hodl, but you gain the income while doing that.
Exactly. So in this particular scenario, if you scroll up, let's look at go ahead and select SATA. Just click on SATA. Yep. And then the period down to 3 years instead of 5. Yeah, now scroll down there and let's see if the CAGR changed. See, now all of a sudden you do have a positive CAGR. And the reason why is because with the capitalized interest structure, every year your loan balance increases by the amount of interest, right? So in this particular loan, you're borrowing the $1 million, but you're also borrowing the $100,950 or whatever it is for the interest, right? So then in year 2, your loan is going to be that 1 million plus the 100,000 in interest. So every year your loan is increasing by the amount of interest. That's why the more years you go out of, the net CAGR figure can come down ever so slightly. But even then, I mean, the fact that you can collect a $10,800 paycheck, so to speak, every month to live your life on, while your Bitcoin is still able to sit there and appreciate at the same 30% CAGR that you're looking for, like that's really the benefit, right? And that's why we look at this as a creative way to generate income on your Bitcoin, because you're not selling your Bitcoin. You're still exposed to the long term positive carry or the long term positive growth. And you're doing so in a way that basically offsets all of your interest expense and gives you, a biweekly, or now with SATA, a daily dividend check to live your life on.
So basically, you keep the Bitcoin, you keep the same Kager, roughly the same Kager here with SATA 30.2 instead of 30, and the other one was like 29. Like I don't think that matters too much. I mean, of course, like with big sums, it adds up, but roughly the same Kager,
Yes.
plus you're getting cash. And I mean, this is like a big example. Probably if you work with a lot of high net worth individuals, that might be more realistic. But for the average listener, like a 10 grand per month on like passive income on the Bitcoin you already hold, it
Mhm.
seems like a lot. Let's choose let's choose a little bit of a lower one. What do you think is kind of the average size that's more realistic? Let's say like 200K, 150. What I don't know what makes more sense when we have 150K.
Yeah, I mean it depends on what you need to live life every month, right? So if you are somebody who lives in, I live in Seattle and the cost of living here is pretty high, whereas if you live in, rural Mississippi, your cost of living is going to be significantly different than what I might pay here in Seattle, and both of those might be completely different than what you pay in Austria and what others pay in another part of the world. So that's the point of the calculator, though, is you can key in whatever your values are and kind of see how that looks, and maybe that's an enhancement we bring in the future, right? Is, well, how much money do you need every month, and then be able to show you how much cash that would require, how much Bitcoin would be required to get the loan, etc.
I just looked it up. It's uh, like an average. I mean, it's of course like very hard to do an average over the USA because the USA has a lot of different places. But if I just ask that question to Gemini, and it gives me like 3 to 3.5 thousand. So let's see, 3, 1, 2, 3. Yeah, let's say 300,000 dollar would be the loan
Yep.
amount,
Yep.
which would be the number 8.6 for Bitcoin. Which is the value about 660,000 US dollars currently, which would give you a little over $100 a day in income from Strive. which would be $3,250 monthly. And with the stretch, it would be 2,875 paid twice per month. So like 1,400 paid twice per month, not the 2,800 paid twice per month. In both examples, you keep the Bitcoin roughly. So with STSC, you lose a bit, like you, instead of like 30%, you gain 29.81%. With Stretch, you, instead of 30, you get 30.21. So roughly it stays the same. And if that's what you need as money, that's retirement money. And so that's an interesting one, because people always ask, okay, how many Bitcoin do I really need to retire? How many Bitcoin do I really need in order for me to live comfortably and not have to worry to burn through my Bitcoin? And that's a really interesting strategy, because instead of selling off your Bitcoin, let's say you have the 8 or 9 Bitcoin, and for a lot of people now, it might sound like a very high number, but it might also say like what you get for that. That's literally like a good average salary in the USA, which you can live on depending where you live. In some parts of the country, you get a good life for that. In some parts of the country, you don't get any good life for that. That's huge already. Like that's like life-changing money for people like here. That's really interesting to have like the calculator to see what kind of number you need to retire with this specific method. And we have more and more methods to retire on Bitcoin, and I think that's a really attractive one. I've never heard about that. So like you sent it to me, I think yesterday, and I saw it and I was like, that's interesting. I needed 1-2 minutes to figure it out, but like that looks really interesting. I mean, of course you have some downsides. Like I think there's no self-custody of the Bitcoin. Like there's some trust in all of those things involved with that. But I mean, if you want to retire and you want to have cash, that's a really interesting strategy.
Yeah. Yeah, it really is. And of course, the borrowers, yeah, you have to find a lender that can, give you what you're looking for from a custody and security perspective. A lot of our borrowers have been with us for a long time because we've been around for a decade. We've never had any major, events, breaches. We've never lost anybody's collateral. We've never had like significant downtime on the platform. We have a 100% collateral return rate for people who have paid off their loans with us. So in terms of our track record and our history, yeah, people really like working with us for those reasons. I think the other thing that makes this product compelling for us anyway is that we have downside protection. So if you really think about what scares people from taking out loans against their Bitcoin, a lot of it has to do with the downside, right? Well, what happens if Bitcoin drops 50%? From the the all-time high in October down to like February, we dropped like 54%. Well, how many lenders had to force liquidate their loans to pay off the balance as to not go underwater, right? Whereas with salt, the worst thing that might happen to you is you get stabilized. That's our version of a forced liquidation, where we just convert your Bitcoin to stablecoin to get it out of the way of the volatility. Now, sure, that might be a taxable event, and you might have to, file that in your annual taxes. But that also might be a write-off, right? If you took out a loan when Bitcoin was 90K and you got forced liquidated when it hit 65K, well, okay, if your cost basis is 80K, then essentially that's a loss that you can write off. But the benefit with salt is that we never pay off your loan. So even if you got or even if you got stabilized, well, you can convert all of that stabilized USDC back into Bitcoin at any point during your loan term, right? So we had some people take out loans when Bitcoin was near the all-time high in October and get stabilized when it was only in the 90 to 95K range, right? Which at the time seemed really scary and was unfortunate. But, through patience and through planning, what did those people end up having the opportunity to do? Well, they got to convert all of that stablecoin back into Bitcoin when it was in the 60 to 70K range and come out with more Bitcoin, right? And that's something that's unique to salt. And that's kind of our floor which is still higher than everybody else's ceiling. And that's why, I think we have a lot of conversations like this about retirement, about buy, borrow, die strategies, about even, Bitcoin treasury companies, because we don't pay off loans. We don't do a traditional forced liquidation. And that removes so much of the anxiety and so much of the fear and so much of the perceived risk of Bitcoin backed loans. And then just to kind of finish that thought, if you want to pay the premium to have full downside protection from Salt Shield, well, then we'll never stabilize you. You'll never get a margin call. You'll never get a warning. You'll never get destabilization, anything, because you paid the premium for downside protection, and that will never happen. So the Bitcoin that you deposit to back your loan is the exact same amount of Bitcoin that will always be backing your loan, regardless of what the price does, because we will never margin call you and we will never stabilize you.
No matter if you already have self-custody or still have your Bitcoin on exchange, your generational wealth that you have in Bitcoin could be completely at risk. And that's why I highly recommend to you to give the Bitcoin Way a 30-minute free consultation call to check how secure your custody setup really is and what you can still improve. So head over to thebitcoinway.com/Robin. Again, that's the bitcoinway.com/Robin and get your free initial 30-minute call with the Bitcoin Way. Finally, we have BTC Prague back in 2026, and this year I'm not only speaking on a panel, but I'm actually going to present an interesting new angle, a perspective, a Bitcoin thesis at BTC Prague this year for the first time ever. I've never done that on any other conference, so this will be a fun one. If you listen to this show on a regular basis, I would love to meet you in Prague this year. It's very high signal, no noise, and Prague is just a freaking amazing city with awesome drinks and a lot of good food. Use code ROBIN to get 10% off, and if you buy with Bitcoin, you get an additional 5% off your ticket price. I'll see you there in Prague. Make sure to come say hi. I will let that here for now because I think it's a really interesting strategy. And as soon as it goes live, ping me and I will put the link in the description somewhere in the YouTube comments, because so people can check it out and see if the link is already there, and put their own numbers in, because to make it useful for all the viewers, we will need to go through like 10, 20 different examples now with different loan values and different lifestyles and things like that. There are a lot of nuances to the whole conversation. Also, like, okay, is that all the money you have, or like, do you only do it with like some kind of money? So there's a lot of interesting conversations had in there, but I will just let it here, because even if you don't have the calculator, you can like kind of play with that in your head, or like make a screenshot and give it to Claude and like make it play with it, and it probably can do not too bad of a job with it till the actual calculator goes live on your website. Now I'm interested in more general questions around those instruments. The first one I've already teased before, and I'm invested in both. Also in, like, I almost don't want to call it like that, but yes, I have some stretch shares just to test it out. But such a small position that I don't want to really say I'm invested in stretch. How do you look at stretch versus Seyr? This is such a new space, and they are very new companies. And the obvious difference is obviously like Seyr pays a bit more per year, and Seyr pays more frequent than Stretch. And Stretch has strategy as backing, so they have a lot more Bitcoin, a lot more liquidity, like just like the bigger player. But how do you look at, from an individual choice, like if you have the choice between those two, like what is your framework to think about what you're choosing?
Yeah, that's a great question. And honestly, I'm still learning about some of the nuances and some of the differences, not just in the preferred equities, but the companies behind them as well, and the people at those companies. I mean, I'm a huge Michael Saylor fan, and I kind of credit him for a lot of my orange pilling, going back to 2022, or when I kind of discovered him and heard his story. And, you know, I think there's a lot. I think there's more moving parts with some of the strategy offerings, right? They've got a number of different preferred equities. They've got a number of different knobs and levers and mechanisms. And, they also have their operating business, the AI, the software, and other things. So their income statements, their balance sheet, everything probably looks a little different for strategy as an organization. Whereas when you look at Strive, right, they are more of a pure play treasury company, right? And so, everything they're doing is really based on and built around these products and this product in general. And you look at Jeff Walton and some of the things he talks about having full transparency to the balance sheet. They want to show people what they're doing. They want to explain the math. They want to give people, perspective into everything that's going on, which I think resonates well with retail investors, especially because sometimes it is kind of hard to know, well, what's really going on? Do I really understand all these things? There's a lot of moving parts. So I don't know. I don't know how that plays out over time. Do more of the institutional players, do they make their way to the stretch product, or perhaps others within Strategy's portfolio? And does retail lean more favorably toward SETA because it's got a higher APY and it's maybe a little bit easier to kind of understand what they're doing? Not sure, but I love the fact that both companies exist. I love the fact that they seem to be friendly and collaborative with one another. And I love the fact that they've got some of the smartest people I've ever met, with their hands on those knobs and those levers doing the things that they're doing.
I think it's a net positive that there's competition. With, I mean, in every that's a very general statement I just made. Like in every single market, it's always good to have competition for the end consumer, but also for the individual company, because it drives them, it motivates them to be the best version of themselves. Like if you're the best and there's no competition inside, it's kind of boring. I think
Absolutely.
that's not what life is about. You want to have some friendly competition. What I'm always thinking, and I'm curious how you think about it, because I mean we are in our Bitcoin bubble, and we look through everything through the orange glasses. And someone outside of Bitcoin might say, okay, now they are using a private credit instrument. Oh, not private. They're making a digital credit instrument. Then the retail investors takes a loan against the Bitcoin, buys a credit instrument with that, gets cash, buys even more Bitcoin with that, and with that more Bitcoin, he can again borrow more against it, buy more. Like it's almost like the Bitcoin market developing tools to propping itself up. Is there any structural risks that there might be occurring, that we Bitcoiners are too loving to see in our own market?
Perhaps. I mean, at the end of the day, I mean, everything you said there, makes conceptual sense, right? If you've been stacking Bitcoin for years and now you're going to use that Bitcoin to extract fiat liquidity against it, and then use that fiat liquidity to essentially lever yourself up, because SATA or Stretch are both built really around the nucleus of Bitcoin, right? So in a sense, you are levering up in that way. And is that always going to be risky? Not necessarily, but if and or when things do go south and there are potential failures or insolvencies or corruption or fraud or whatever it might be, it's typically the unwinding leverage that creates the cascading effect, right? So could there be systemic risk in some of these things? Perhaps. But the way I look at this particular strategy is more just the opportunity to double down on your conviction, because this isn't suggesting, hey, you like Bitcoin, borrow against it, lever it up, buy more Bitcoin, lever that up, buy more Bitcoin with that, lever it up until you've got 10, 20x leverage. That's dangerous, right? Because you don't have any room on the downside in that scenario, right? If the Bitcoin price falls even just a few percent, you could get completely wiped out. Whereas with this strategy, really all you're doing is putting the Bitcoin to work in a way that generates the income that you need without having to let somebody else trade the Bitcoin, or without having to sell the Bitcoin, or without having to relend the Bitcoin, right? And you're doing so by really just placing a bet on these preferred equities that are also built on Bitcoin. I actually heard Seyr say this at Bitcoin for Corporations in February. The first couple of remarks that he said was, if you're already a believer in Bitcoin, then you are by proxy a believer in Stretch. And I'd never really thought about that. And I thought, he's right. So, like, as a company, if you're a Bitcoin treasury company, or perhaps you're using a Bitcoin treasury strategy for yourself or for your trust or your estate or just your retirement or whatever, well, then whether you have Stretch exposure or SATA exposure or Bitcoin exposure, you are kind of placing the same bet there on the underlying instrument, which is ultimately Bitcoin, right? The asset that's kind of powering everything there is Bitcoin. So, is this going to be a strategy that everyday people adopt, right? Are they going to sell all their Tesla and Apple and Google and Nvidia equities to go buy Bitcoin and then lever it up this way? Probably not. Right? But is this a way for Bitcoiners to get exposure to these preferred equities without having to sell their Bitcoin? Absolutely. And that's something that I continue to hear within my day-to-day work at Salt is, I don't want to sell my Bitcoin, but I do like the idea of getting exposure to these income products. How do I do it? Well, this is really one way to do it. And I think the more people kind of realize that, the more it opens up the demographic of pure Bitcoiners for these preferred equities. Whereas right now they're really just focused on fixed income investors. And those two things are just different, right? If you're somebody who believes in the future of Bitcoin and you've built your nest egg around it, well, if you want to now put that to work, what are your options? And I think this gives you a way to kind of bridge those two worlds.
I think it's I think it's the start of Bitcoin being the foundation of our financial markets. And not is it's not 100% clear to me if that means that Bitcoin is the new reserve asset, or it's money, or like whatever label we want to kind of put on that. Probably both is kind of correct. But I think it's the start of people realizing Bitcoin is the best asset possible, the best foundation if you want to build something. And so if you want to build leverage products, borrowing products, digital credit products, whatever you want to build on that, you better build it on Bitcoin. It has the best chance to succeed. And so I don't know. I feel like we just see the unwinding of fiat and the start of something new, and we're just very early to that game. And so it's hard to see exactly where we end up in 10 years, 100 years, 2000 years.
Absolutely. Yeah, and I mean, just being in the lending space, I mean, I've been a Bitcoiner for a while, but being in the Bitcoins or in the lending space now and just seeing the competition is just so fierce that rates are going to continue coming down and value and benefits are going to continue going up for borrowers. So on the lender side, we're constantly looking for ways to get better rates, find cheaper capital, increase the security, the transparency of custody, add things like downside protection so there's no forced liquidation events, improve the UX, the tools, the features, everything that the borrowers get to use, add more personnel, expertise, guidance, people to help the borrowers better understand these products. And so I just think, as this space matures and the competition grows, it's only going to continue benefiting the individuals, in this case, the borrowers, because we're all trying to bring more value for less money to the marketplace. And that's why I think you're seeing better rates, you're seeing better terms, you're seeing better fees and value and benefits in these products over time.
Yeah, 100%. Will be really interesting to see. It's also I think it's a good point that you brought up this borrowing against the Bitcoin, because when I first looked at it, I don't know, a year, 2 years ago, I don't know, I don't even know when I first time looked at borrowing against the Bitcoin. I just remembered that the rates and the terms were so horrible. I was like, why would you do that? And it gets to the point where it gets more and more feasible, like around the 10% mark. It's better and better terms also, not just the interest rates, but also the holding periods, the downside protection. The space gets more mature. It's just a way better space now than just 2 years ago. And imagine like the competition and the market driving it even better in the next 2 to 3 years. I mean, I'm still not a user of any borrowing against my Bitcoin. Partly also because I still have some fiat debt that is just like at, I don't know, 3-4%, which I first want to kind of slide down before I go do anything else. And it's like super attractive to have that. But without that, if I didn't have that at all, and also didn't have the option to get loans at under the 10% mark, like it's a nice option for Bitcoiners to do.
Yeah, absolutely. Yeah. Yeah, I mean, I think it all comes down to, your conviction in the asset, right? I mean, that's why whenever I build a model or a calculator or I have a conversation with somebody, I say, well, what's your projection for Bitcoin? Right? Because these things are all subjective to the individual. But if you're an individual that thinks Bitcoin's going to average 30% CAGR for the next decade, well, then just do the basic math. Like, paying a loan of 9-10% interest per year when the asset that's backing that loan is growing at 30, that's pretty easy math, right? I think at that point the homework becomes, who do you borrow from? What's their track record? Where have they been? What have they done? Who are they? And kind of what's going on under the hood. Seyr talks about this, at least he has in the past, and he's referred to the 2022 collapses as really the crypto cowboys, right? Your FTXs, your Celsius, your BlockFis, your Voyagers, your Genesis, etc. And I think because a couple of those were lenders and, exchanges and companies offering yield in exchange for the Bitcoin, people still have scar tissue, and rightfully so. That's why I'm a big supporter and a big believer in the Clarity Act. I know it's kind of boring, regulatory jargon for most people, but if you look in there at what's coming for exchanges and custodians, right? It's just enhancing the strength and resilience of the infrastructure and the big companies and the big names that prop up this industry. Where in 2022, several of them failed, and that created massive cascading events across the entire space. Whereas with the Clarity Act in place, and let's hope, fingers crossed, some level of competent oversight and enforcement of the laws and the rules across custodians, exchanges, and some of these other systemically important entities across the industry, it's only going to continue to strengthen this market and strengthen, companies like us who are dependent on, some of those entities, custodians, and things of that nature. So I just think as we get further away from 2022 and we move further into the future, right? Again, the value, the benefits for consumers of these products is only going to continue to increase, while the cost for them is going to continue to come down.
One question I had, because I had that recently in my head. I mean, I have it constantly in my head actually when I think about borrowing into Bitcoin. Why are the loans still so high in the interest rate? Because there's like more competition coming in. There are car loan offers for like 0%, 1%, 4%, 3%. There are home loan offers for like 2 to 5%. Even like overdraft and some consumer credits for like, I mean, it's not a huge amount, but like for a little bit, you get it for 7, 8, 9% sometimes. It, and then there's Bitcoin, which is, in my opinion, just the best collateral asset ever. Why is the Bitcoin lending and borrowing market still at like 10, 9, 11, 12%. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today. And you can make with that unlimited amount of backups. Go now to microseed.io. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC-free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control. And I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together.
Yeah, I mean, it's still considered more of an emerging asset class, at least when it comes to traditional capital markets. You know, a lot of those consumer loan products that you mentioned too are offered by banks, and banks have direct access to the Fed in different means, right? They buy treasuries, kind of support their balance sheet, and the yields on those treasuries tend to represent the floor in terms of interest. Like, why would you do an auto loan at 3.5% if you can get a 5-year treasury that pays you 4%, right? You wouldn't do that. The math doesn't really work. Um, and lenders like Salt and others, we don't necessarily have access to some of those same resources that banks do. So we go out and we secure capital from the private capital markets, the institutional markets, and that's another layer between the ultimate core, the ultimate Fed, the ultimate banking system and rails and money networks and us. So we do oftentimes pay a premium for the capital. The other thing I would say is, people are still getting comfortable with the liquidation mechanisms and the automation and the tools and the technology that protect the capital that backs these loans, right? They still look at Bitcoin as a very volatile asset that could drop, 50% in just a couple of months, like it did from October to, early 2026. But as those people learn and understand how this works more, they're actually coming out with a completely different understanding because they realize, wow, the tools, the tech, the automation can actually, protect my interests because Bitcoin is a 24/7, 365 global market where, basically any position of Bitcoin can be liquidated at any point in time, right? If that's what is required to protect the capital that's backing a loan. And so I think as more people come to understand that, the more people are realizing, more capital allocators are realizing, maybe this Bitcoin lending and just Bitcoin asset, backed market, right? You saw what Ledin did with their asset backed portfolio, right? They were able to do that because enough people said, hey, I want to invest in Bitcoin backed loans. And so I think as more of those things happen and more people bring that kind of attention to this space, the rates are going to continue to come down because we're going to start getting access to that cheaper money as the interest and as the level of awareness and understanding in Bitcoin, the Bitcoin market, and some of the different tools that we have to protect their positions, as that level of awareness just continues to grow.
Interesting. Is there actually, because you talk with a lot of people that come to you and ask you like, okay, that's my situation. How can you maximize how can I maximize my portfolio? Is there a way, or is there something that you say if you have that situation, or then you shouldn't do those things? Like, is there a thing where you say that's an argument against doing borrowing against a Bitcoin, doing all those things, or is there like a almost like a minimum threshold that you like beyond that it does not really make sense, or below that it doesn't really make sense? Do you have like n- red flags or negative things that you like? If that's the case, you shouldn't do all those things.
I mean, the one that comes to mind has really nothing to do with loans, so I'll call that out in a second. But to answer your question, I mean, most people come to me, when they have questions around their Bitcoin stack and they're thinking about retirement or they're thinking about a strategy for their balance sheet at their business or for their personal lives. And so oftentimes those people have already kind of made the mental, emotional decision of at least being ready to explore a Bitcoin backed loan. The one that comes to mind for me is I have a couple of friends who are like, man, I want to earn 11.5% with stretch. And I'm in my early 40s, they're in their early to mid 40s. And I'm like, well, why would you do that though? I mean, your long-term thesis is that Bitcoin's gonna, outperform all those things. So why would you sacrifice your holdings to earn 11 and a half with stretch? And and so that's where I push back on people is to say, well, if you're long Bitcoin and that's your growth asset and your growth strategy, it probably doesn't make, at least the math that I've done, mathematical sense to sacrifice those allocations to earn only 11.5% on stretch if long term you think Bitcoin's going to do 20, 25, 30% CAGR, right? Unless, of course, you've already got the Bitcoin and now you're ready to start talking about income strategies to power your life. So that's where I typically push back on folks is when they say, I'm thinking about selling some of my Bitcoin to buy stretch, or I'm going to change my IRA portfolio, my retirement portfolio, and generate some income with stretch. If you're in your 30s or 40s and you're nowhere close to retirement and your long-term thesis and strategy is built around Bitcoin, that's typically where I would push back and just encourage, to do some of the math.
Love it. Really cool. I think this whole topic is really interesting. And what I wanted to achieve with this podcast also was to show people another option out there. Because a lot of people just like buy and hold Bitcoin in self custody, which I think is like tremendous, like it's amazing. And the it's such a hard strategy already to beat. Um, but if you have a special need, special needs sounds very bad now, but if you have a situation where you say like, okay, I want to slow down, or I want to retire, or want to do something, or I want to have an income strategy, or all of any of those things, there might be a unique opportunity for you to borrow against a Bitcoin, a unique opportunity to use Stretch or Seyr for you. And this is just like you just gained another tool in your Bitcoin toolbox, which you should be aware of. Not saying you should use it. Most of your wealth, I personally think, should always be in Bitcoin self custody, but doesn't mean that you can use some tools outside of that, outside
Yep.
of self custody Bitcoin.
Absolutely. And I think most people watching this probably it's not, we're not really reinventing the wheel, right? It's not necessarily rocket science, right? You take out a loan against your Bitcoin, you buy Stretch or SATA, you earn the dividend. I think where it gets interesting is if we can strip out the volatility with downside protection, right? What level of comfort and confidence does that give the borrower to really then explore this strategy? And then if we can also eliminate the monthly payment so you can fully realize the dividend, well, then how does that impact the strategy? So I think at the core, right, borrowing cash, using that cash to buy Stretch or SATA, earning the income, pretty straightforward concept. But when you combine that with no margin calls, no downside risk, and no monthly payments due, I think that's what really creates like the, oh, interesting kind of conversations.
100%. And as you well know from the previous appearances that we have an end routine where the previous guest is asking a question for the guest without knowing who the next guest actually is. And the previous guest asked you the question, what is the one fear that you have about Bitcoin that keep that you keep to yourself that you don't tell anyone else? Maybe you have none of those fears, but I'm curious how you think about fears and things about that in Bitcoin.
Yeah, that's a great question. I really like it. I was at a small Bitcoin event this past weekend, and I've had been having a lot of conversations with friends and family about, what happens at the core of Bitcoin, right? Bitcoin core developers and Bitcoin knots and the BIP 110 soft fork and some of the other things that are going on there. And I think that's probably where I tend to have a little more fear and anxiety. And I think it's just because I don't understand that as well. I'm more on the investing side, on the market side, lending, custody, risk, long-term, growth and things of that nature. So I don't necessarily understand everything happening at the development level as well as I would like. And just seeing, some of the different conflicts and some of the different disagreements on things, and not necessarily understanding all of how that works or why it's important. That's probably where I get a little bit of fear.
Yeah, it's the unknown, the unknown of the unknown that keeps you. It's also like as we are very, how should I say it? We Bitcoiners are very convinced people. Like we are very sure people because we have done a lot of research, and most of the times when you hear things against Bitcoin, it's so stupid that you almost don't want to answer to that because it's like, oh yeah, but Bitcoin is bad for the environment. Oh yeah, Bitcoin is so volatile. Like, like that. I don't even like when I hear it, my head is like, oh, no, it's like such a thing. And then we can forget that there are still questions out there in the Bitcoin ecosystem that will needs to get answered. I'm very sure that they will get answered, and I'm very confident about that. But being open to what what are the risks and what are the uh, potential downsides to Bitcoin, I think is always a constructive and good exercise to go through yourself because there's a good critique out there, but usually those don't come from people that haven't researched Bitcoin like most critics.
Yep. Yeah, no, it was refreshing. I mean, one of the panels was a lot of people really close to the Bitcoin core and development community. And it was really interesting to hear them speak and get a chance to talk to some of them after the fact because they're just so smart and they're so passionate, that it just elevates my level of comfort and confidence knowing that these are some of the people that have their hands on the knobs and the buttons and are working together to make sure that Bitcoin is strong now and into the future.
Was it because I know that there was a conference, how's it called? The Bitcoin is for everyone conference or something like that?
Yes.
Ah, nice. So it was a good conference. Fritz, a friend of mine of Microseed, was also there. But yeah, thank you so much, Shane, for being on the podcast. Yeah, before I let you go, where can people find you? Where can people find the things that you're doing? And where can people find the calculator once it's live?
Yeah, you can follow me at X. It's Shane3628, and saltlending.com is where we publish a lot of our resources, tools, blog posts, white papers, you name it. And then once we get that calculator published, yeah, we'll probably share it across our X accounts. And it'll certainly be posted on our website. We've got a couple others we've been working on, so we're trying to, get all of those brought forward at the same time to give people just more ways to get hands on with loans, with retirement strategies, investment strategies, and everything else. So once we do that, we'll share that across our X accounts, and I'll be sure to send that to you directly as well.
Awesome. Thank you so much, Shane, for being on the podcast. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.